Can you realistically follow Dave Ramsey's 8% retirement rule? Now, when we finally get to retirement, most financial advisors say to take 4% of your portfolio every single year. This gives it the ability to grow. But could you take 8%, taking twice what they recommend of the national average? Now, let's take a look at this. Dave Ramsey says that all retirees should have their assets in equities, then draw 8% per year of their portfolio starting value, which each expenditure adjusted for inflation. So that means if you have 500,000 in a portfolio, in year number one, you would withdraw 40,000. If the inflation is 3%, you would withdraw 41,200. In year two, it'd be 42,436, so on and so forth, getting up to the number essentially that you're getting 8%. Now, the typical stock return is around 10 to 11%, which would cover the 8% that you're taking out. Also, you could go ahead and do this a little bit different with inflation. That is entirely different than we normally see with the 4% rule. That recommends spending no more than 4% of your investment during the first year of retirement, and then of course adjusting it every single year for inflation. So if you're taking out 4% and your inflation is 3%, that means you're taking out 7 in total, which again is going to be pretty interesting to see, because essentially the way that Dave Ramsey sees it is never touch the golden goose. I know that is something that he said before. So when you think of a retirement portfolio, and let's say, for instance, just to make it easy, you have $1 million in this retirement portfolio. If you're taking out 8% a year, chances are if it is growing faster than that 8%, you're never going to touch that original $1 million balance that you have in there, which is the reason. Now, of course, when you start looking this and when you think of kind of the big situation, the financial rule, the 4% rule and the 8% rule does not apply to everyone. Largely depends on your financial situation. In the case of Ramsey's 8% rule, it assumes you're a big enough nest egg that you can pull out 8%. And of course, you can live on that 8%. Again, this is going to make a big difference because most Americans will not be able to retire or not be able to afford Ramsey's retirement rule, even at the 8%. Now, of course, thinking big picture, if you cannot pull 8% of that portfolio to survive, doesn't mean that you can't pull 4% of that portfolio to survive, because essentially people are pulling money out of retirement accounts much faster than they need to because of the cost of living that is exponentially more expensive. They need more money to survive. Now, of course, looking at the average retirement savings per Vanguard, ages 55 to 64 is 207,000. That is the average retirement savings at those ages. Then, of course, looking at 65 plus, you're looking at $232,000 at age 65, which is per Vanguard. Paints a little bit of a different picture because when you look at the median retirement savings per the Federal Reserve, now, of course, we're looking at the Federal Reserve, 55 to 64, 134K, that is right, $134,000. When you look at ages 65 to 74, and also looking at the median retirement age of the Federal Reserve, so 55 to 64 is 134K, so definitely quite a bit lower. When you look at 65 to 74, so these are the key retirement ages. Majority of people retire at age 65. The total balance of these accounts are 164,000 for the median, so which is crazy because neither of these figures will allow you to go through that 8% rule because you're going to run out of money. That is essentially what is going to happen. And also, I want to give you my take on this in just a minute. But if you have 232,000, which again is the average in a portfolio, then you need to get by with $18,000 a year for retirement, in inclusion to Social Security. So if you think about this, again, for the big picture, if you're taking out that 8% and you're getting that $18,000 to supplement your Social Security, you better have a very, very good plan. You better have zero debt. The mortgage better be paid off if you want to actually live on the income that's coming in, because the average Social Security payment is around $1,800. For a majority of people, if you are a single household, you could look at that and just kind of running the numbers of what you get, because of course you're still going to have to pay taxes and everything else on that. You're talking about living on about $4,000, which for some people might be okay. Some people, it is going to be way behind what they're normally making. Now, if you have a savings of 164,000, then the 8% rule gives you $13,000 to spend. And again, this is where it is very different between having the portfolio that has 232,000 and having the portfolio that has 164,000. Because of course, now instead of the 18,000 a year, you're only getting 13,000 a year in addition to Social Security, which again, doesn't really give you much to live on. When you think of the poverty level, you're almost at the poverty level, even just being on Social Security. Now, of course, this is the big part that really changes. when you think about the investment strategy, and this is why I really recommend the 3 ETF portfolio, is when you look at the investment strategy, this is based on the average stock market return that Dave Ramsey is talking about of that 10 to 11%. If you're like a lot of people that, let's say, have target date funds, when you start getting to retirement or you hit that age 65, and your target date funds put a lot of money into bonds, put a lot of money into a lot of the safe money, chances are there's no way you're going to be getting that 10 to 11% annually. And of course, this is going to be detrimental to your retirement plan. When you get into retirement, when you hit 65, if half your portfolio goes into bonds and the bonds are paying, let's say 2%, you're taking out 8% every year. Even if you're taking out 4%, then you adjust it for inflation. If you're only making 2 with the bonds that you have in there, you are losing money very, very fast. And the portfolio that you built is not growing really at all, which is the reason why upon retirement, I really do stick to that 3-fund ETF portfolio. And of course, the big reason is when you get to retirement. So let's say, for instance, you hit 65, average life expectancy of a male is 87. I still have 22 years that I need this money to go ahead and last. In addition to that, I still have the opportunity to get 22 years of growth out of this portfolio, meaning that I have to outpace what I'm taking out. I have to outpace inflation. Everything said and done, you don't want to be losing money in your portfolio. And a lot of people that I see getting into retirement, where if they're making $100,000 a year, they retire, now they're on just Social Security income. And then of course they have the 401k or they have the IRA plan, and they all of a sudden start taking out a lot of money out of that plan because Social Security might give them 30K. They're used to making 100,000, means they have to make up that $70,000 essentially deficit because they go into retirement with an absorbent amount of bills, which does not work at all. So an 8% retirement rule, is it possible? Definitely is if your portfolio is set up correctly and if you retire a little bit later. Now, again, this is another thing to really remember. When you start looking at a fairly large nest egg, when you start getting those balances high, 8% rule will work if you retire later. They are looking at 68, 70, 72 to retire. So actually being well past the retirement age. According to Forbes, you can realistically retire on the 8% withdrawal rule as long as you choose a good close-ended fund with at least a steady 8% yield. The trick is getting the steady yield along with those higher balances for a number of years while you're taking money out of this portfolio. And of course, volatility does really 2 things safe with these withdrawal rates. First, retirement portfolios can fall in value pretty quick. So if we have another 2022 where portfolio values are down 20%, all of a sudden you're pulling out 8 or 10%. That's a pretty big hit. Now, of course, if you withdraw a fixed amount, and we have seen this from BlackRock, where they actually have a portfolio, a portion of your money goes into a set monthly payment that you're going to have. So they're going to give you a monthly check. So essentially a portion of that 401k portfolio moves into an annuity, and the annuity is going to pay you every month. This, I think it has some pros and cons behind it, including one, which is you're going to have a steady paycheck. You know, you're going to have money coming in every single month from that annuity. The other side of it is it might not grow as fast or as high as you want to because you have it in that annuity, but also it keeps people from spending the absorbent amount of money when it comes to retirement and essentially running out of funds in their entirety when it comes to retirement. So does it make a difference if you're taking this 4% or you're taking the 8%? Me personally, you have to have the growth. That is really the big thing that I think a lot of people overlook and a lot of companies even overlook. When we start looking again, I had Vanguard target date funds. The target date funds over the last 10 years were underperforming the market itself, meaning that I was seeing a growth of about 6 to 7%. I took everything from my target date funds. I moved it over to some large cap, mid cap, small cap. And of course, I do not do the international. Now I've been seeing a growth of about 18% this year, which is pretty incredible considering what we do have them invested in. If I would have stayed in those target date funds, I would have been at about 6 to 7% this year, which is the reason why you have to adjust and you have to maintain that 401k. And also, if you're putting money into IRAs and other investment accounts, that it is properly invested. If you are not properly investing these funds, they're not going to grow like you need them to be able to retirement. And of course, for a lot of people, including myself, I do not want to wait till I'm 70 years old to retire. I want to invest much, much younger than the 70. I'm thinking 50, maybe even 55 if we're pushing it for retirement, but I do not want to wait till I'm 70 because again, Life expectancy, 87 years old. That gives me 17 years after I retire. I would rather have 37 years, I don't know about you, to go ahead and do what I want to versus that 17 if I am a late retirer. So all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.